Welcome back to HDIN Research. Today, we're performing a post-mortem on the analog world. 2026 is officially the year where making a good pen is no longer a business model. It's a survival test. While the world obsesses over AI chips, we're looking at the $190 billion giants fighting digital extinction. It's a game of pivot or perish, and some of your favorite childhood brands are currently on life support. Let's dive into the financial DNA of the stationery hegemony. First, a reality check. The stationery market is now worth $190 billion. To put that in perspective, that's enough to buy every single person in New York a brand new Tesla. But don't let the big number fool you. The utility era is dead. People aren't buying pens because they need to write. They're buying them because they want to feel something, or because an enterprise algorithm told them to. It's a K-shaped split. If you're stuck in the middle, you're just roadkill. Why is the industry sweating? 3 words. The demographic cliff. In China and Japan, the student population is shrinking faster than a cheap eraser. No kids, no pencil cases. It's that simple. Combine that with interest rates that make ACCO's debt look like a mountain range, and you've got a triangle of doom. If your strategy is still selling notebooks to students, you're essentially trying to sell heaters in a forest fire. How do you survive the apocalypse? There are 3 paths. M&G and Pilot are building moats through B2B digitization and high-end tech. ACME United was the most ruthless. They ditched the scissors to become a medical safety powerhouse. Then you have legacy zombies like Sailor Pen, incredible craftsmanship, but in terms of business agility, they're basically a museum exhibit. Let's talk receipts. M&G is the apex predator here, with $3.49 billion in revenue, lapping the field twice. ACCO is struggling just to keep its head above water. But look at ACME United, only $200 million, yet they're incredibly lean. In this market, being a legacy giant with high debt is like wearing a lead tuxedo to a swimming race. Size doesn't matter if you can't move your feet. In consulting, inventory is poison. M&G's inventory cycle is just 30 days, while Pilot takes 120. That means M&G turns their cash 12 times a year, while others are watching their stock gather dust. Even crazier, M&G's cash conversion cycle is negative 10 days. They are literally using their suppliers' money to fund their own growth. That's not just selling pens. That's elite-level financial leverage. How does M&G keep winning? Meet Colipu, their $2 billion secret weapon. They've built a SaaS-like procurement platform that makes them indispensable to Fortune 500 companies. They aren't just selling paper. They are selling the anti-headache solution for office managers. While others fight for pennies at retail, Colipu locks in billion-dollar contracts. It's the ultimate Trojan horse strategy. For Gen Z, stationery is lifestyle jewelry. Brands like Jiumu are driving premiumization through IP collaborations. If a pen makes you feel like a character in a manga, you'll pay 5x the price. By turning functional tools into emotional collectibles, leaders are bypassing the price wars. In 2026, if your product doesn't have vibe capital, it's invisible. Look at ACME United's pivot. They used to be the scissor people. Today, 66% of their revenue comes from medical safety. They didn't just change products. They changed their entire destiny. They moved from a low-margin commodity to high-margin compliance. It's a masterclass in strategic Darwinism. Adapt your DNA or go extinct. Time for a reality check. M&G looks like a rock star, but their accounts receivable grew by 18.5%, while revenue only managed 3.5%. Translation? They might be buying growth by giving customers too much credit. In McKinsey speak, that's a liquidity warning. In street terms, it's like bragging about your sales while your friends still haven't paid you back for lunch. Watch the cash flow. Here is the tragedy of Sailor Pen. They make the world's best 21K gold nibs, but Heritage doesn't pay the rent. They've been bleeding cash, and their auditors are literally flagging going concern risks. Craftsmanship without commercial agility is just a very expensive hobby. If you don't evolve, you don't become a classic. You become a cautionary tale. The China Plus One strategy is no longer a theory. It's the standard. KOKUYO's move into Vietnam and Pilot's expansion in India are all about decentralizing risk. Meanwhile, ACME United is reshoring to North America for 24-hour fulfillment. In 2026, the winner isn't the one with the cheapest labor, but the one with the shortest distance to the customer's doorstep. Innovation in 2026 isn't just about ink. it's about ESG and tech. KOKUYO is making resin from office waste, while Pilot is building digital pens that sync your handwriting to the cloud. We're seeing a fusion of analog soul and digital brain. If your R&D isn't focused on the circular economy, you're designing products for a world that no longer exists. What's next? AI-integrated writing systems that track your posture, and net-zero supply chains where recycling is a revenue stream. Stationery is moving from supplies to managed ecosystems. The giants that survive will be the ones that manage your entire hybrid office infrastructure as a subscription. The pen is still mightier than the sword, but only if it's connected to the cloud. The takeaway for 2026? Agility beats scale. The winners pivoted from products to services and from utility to status. In the stationery war, efficiency is the ultimate weapon. If you're a legacy brand, your history is either a foundation or an anchor. Make sure it's not the latter. This was just the executive summary. Our full-page deep dive includes granular risk scores for every major player. If you want the data to bulletproof your portfolio, email us at sales@hdinresearch.com or click the link below. Don't forget to subscribe to @HDIN230 for more financial forensic deep dives. I'm the Chief Analyst at HDIN Research, and I'll see you in the next one.